Welcome to the Explainer. If you've got an exam coming up, you are in exactly the right place. Today, we're taking your syllabus and transforming it into a masterclass on finance and strategy. We're going to take all those complex mechanics of corporate finance and strategic alignment and distill them down into clear, highly memorable concepts. By the time we wrap up, you're going to have a rock-solid mental framework to walk into test day with absolute confidence. Let's get into it. So, here is our game plan. We've built a cognitive roadmap that maps out exactly how technological transformation, modern business roles, and strategic funding all link together. We'll start with the evolution of the finance function, meet the modern business partner, align our strategy with funding, and then unpack both our long-term and short-term capital toolkits. Kicking things off with Section 1, the finance function evolution, from abacus to AI. Rapid technological shifts haven't just changed the tools we use, they've completely rewired the entire accounting ecosystem. Now, cloud computing might sound like old news, right? But for your exam, you need to articulate its specific strategic business impact. The absolutely crucial point to remember is that the cloud shifted IT from a massive, fixed upfront hardware cost to a flexible, variable operational expense. Because the software runs on a provider's server, businesses literally only pay for what they use. Plus, it completely democratizes data. Suddenly, teams all over the globe can run real-time analysis simultaneously. It's a total game changer for accessibility. Okay, let's talk about a major exam favorite, blockchain. Historically, accounting relied on private ledgers with a single owner, right? Well, blockchain fundamentally eliminates that. Instead, it is a distributed ledger. It's shared and replicated across multiple computers. This means everyone participating can view and verify the transactions, which drastically reduces the risk of fraud. And the best part? Once a transaction is validated and recorded, it is virtually impossible to alter. To really grasp how secure this is, think about this analogy. A block needs a unique code, called a hash, to be accepted. Calculating that hash is exactly like trying to find the code on a combination lock that has over 100 digits, just through trial and error. If you get a question on how blockchain secures data, seriously, use this combination lock analogy. It perfectly illustrates the sheer cryptographic weight behind the technology to your examiner. And what's really fascinating is how the digital impact on finance is defined through these 5 V's. We've got velocity, which is the sheer speed of business today, volume, the massive explosion in transactions, value, the pressure to actually pull meaningful insights from all that data, variety, adapting to a million different systems, and veracity, the absolute truth and reliability of the data. Memorizing these 5 V's give you a fantastic, structured framework to explain exactly why accountants aren't just bookkeepers anymore, but data-backed strategic advisors. Which brings us perfectly into Section 2, the modern business partner. Number crunchers no more. Because as the tech has evolved, the actual humans in the finance department have had to evolve right alongside it. This comparison is an absolute must-know. Traditional finance was obsessed with keeping the score. It was a rigid, hierarchical, head office function completely bogged down in manual bookkeeping. But look at the modern business partner. The shift is dramatic. They are decentralized, physically sitting out in the actual business divisions. They aren't just reporting the news, they're actively designing and executing strategy. By automating the boring stuff, they act as highly collaborative internal consultants. Now, not every business keeps this talent in-house. If you are asked to evaluate structural alternatives, knowing this rapid-fire list of outsourcing pros and cons will score you immediate points. Outsourcing is super cost-effective, especially for small companies, and it frees up management to focus on their actual product. But the trade-off is steep. You lose that brilliant internal strategic partner we just talked about, you risk losing confidentiality, and you might face real delays in getting the management info you need to make decisions. So, is there a middle ground? Yes, the shared services approach. Keep the Vodafone Budapest example in your back pocket for your essays. Instead of outsourcing to a random third party, a multinational like Vodafone consolidates its internal finance, HR, and IT into one centralized hub in Budapest to serve all of Europe. It's brilliant. It perfectly demonstrates how a company can leverage a highly skilled central workforce to cut costs without fully giving up control to an external outsourcer. All right, let's move into Section 3, strategy and funding alignment. The big picture. This is where the rubber meets the road. We are tying an organization's high-level strategy directly to its wallet. Now, the breakdown mapping funding strategy to the BCG matrix is pure exam gold. Look at the logic happening here. A problem child in the introduction phase is burning through cash, right? So it needs high-risk venture capital and pays absolutely zero dividends. But a mature cash cow, it has steady, predictable cash flows. That makes it perfectly suited to take on regular debt payments while paying out high dividends to its shareholders. You've got to memorize this mapping to show exactly how capital shifts as a product matures. But beyond the product lifecycle, you have to consider the environment. Always remember the golden rule of risk. If an organization's inherent business risk is already high, say they're in a super volatile tech sector, they simply cannot afford the additional financial risk of high gearing, which means taking on high debt. Also, whether a company is privately held or publicly quoted on a stock exchange is going to massively dictate what pools of capital they can even access. So, what exactly are those pools of capital? Let's crack open Section 4, the Long-Term Capital Toolkit. Let's see how businesses actually finance their major, multi-year strategic goals. Here is the eternal corporate struggle: debt versus equity. Debt is generally cheaper because lenders are taking less risk, and hey, the interest payments are tax-deductible. Plus, you don't give away any voting control. But if you miss a fixed payment, you're facing insolvency. Equity is the exact opposite. It's expensive, the dividends aren't tax-deductible, and issuing shares dilutes your control. But it's incredibly flexible. If the company has a bad year, you just don't pay a dividend and nobody goes bankrupt. Now, what about the modern edge of funding? Initial coin offerings, or ICOs. As an aspiring finance professional, if an exam question asks about novel funding, you must critically evaluate it. Don't just say ICOs are innovative. Point out the severe regulatory and transparency warnings. Because they operate on blockchain, the anonymity can totally invite money laundering. Plus, there is a massive risk that the digital tokens issued won't have a secondary market, leaving your investors completely trapped. Another massive tool in the long-term kit is leasing. Leasing is a multi-billion-dollar industry for one simple reason. It preserves a company's immediate cash flow. You get the asset without the massive upfront purchase price. But before deciding to lease rather than buy, you have to weigh these specific factors. What's the total lifetime cost? Can you deduct the lease payments from your taxes better than you could deduct asset depreciation? And ultimately, do you actually want legal title to the asset when the lease ends? Almost at the finish line, Section 5, Short-Term Finance Options. While long-term finance buys the factories, short-term finance is all about surviving the day-to-day cash cycle and, quite literally, keeping the lights on. Let's see how these two essential everyday tools stack up. Bank overdrafts give you instant, flexible cash, but banks charge high, variable interest rates for that privilege, and they can demand repayment literally at any time. On the flip side, trade credit, which just means delaying payment to your suppliers, is essentially free finance. But be careful. Stretching trade credit too aggressively will cost you early settlement discounts, and worse, it will completely ruin the vital supplier goodwill your business relies on to survive. Another brilliant short-term tool is the bill of exchange. This is highly testable, especially in export scenarios. Say a customer owes you $2 million in 2 months. They sign a bill of exchange acknowledging that debt. Rather than waiting around, you can sell or discount that bill to a third party right now for, let's say, 98% of its value. You get immediate liquidity to run your operations today, and the buyer makes a profit when the customer finally pays up in full. To wrap up this explainer, I'm handing you the ultimate exam cheat code, the JS&W criteria. Whenever you have to evaluate a strategic funding source, put it through this test. Ask yourself, is it suitable for the risk profile of the project? Is it acceptable to the shareholders and regulators? And is it actually feasible to obtain in the current market? Master this 3-part test, and you will absolutely ace your exam. But I want to leave you with this thought. If a sudden, massive global crisis hit tomorrow, would your own company's funding pass the test, or would it collapse under the pressure? Thanks for joining me, and happy studying.